Welcome to the Deep Dive, where we cut through the noise, bypass the headlines, and really try to get straight to the strategic core of the biggest stories shaping, well, the modern financial landscape.
Good to be digging in.
Yeah, absolutely. Today, we are strapping in for what looks like a high-stakes digital showdown. It's the battle between two titans of the modern finance space, SoFi Technologies, that's SoFi,
Right.
and Robinhood Markets, H Hood.
The two big disruptors, really.
Exactly. Both of these companies started out as, phenomenal disruptors. One attacking student loans, the other take down commission fees. Big targets.
Huge. They really changed the game initially.
But they've evolved, right? They're far beyond that initial maybe novelty phase. They're now trying to become sophisticated, regulated, and truly diversified financial powerhouses.
Yeah, they're aiming to capture your entire financial life, isn't it?
That's the goal. So our mission today is a deep dive into the source material we have. It's a really comprehensive financial face-off analysis packed with detailed metrics, strategic acquisitions, future projections, the works.
Lots to unpack there.
Definitely. We need to determine which company presents a better upside for you, the investor, maybe the curious crypto enthusiast, over the next crucial, say, 3 to 5 years.
A key time frame.
Okay, let's unpack this. It's really about the fundamental evolution of the modern digital bank.
Yeah, that framing is essential, I think, because it's no longer just about like a temporary disruption. We're really witnessing a war for financial infrastructure.
Infrastructure, good word.
We have to look past the flashy user interfaces and the marketing to truly understand their core DNA, because that structural foundation, that's what dictates their long-term viability.
Especially when facing headwinds, right? Regulatory stuff, economic volatility.
Exactly. All of that.
Okay, so that's our starting point then. We need to establish the foundational difference because their origin stories, they really led them down entirely separate strategic paths. What was the original mission for each?
Right. Let's look at SoFi first, social financing. Its mission was built around solving specific, often kind of painful personal finance bottlenecks.
Like student loans.
Exactly. They started famously with student loan refinancing. That's a high-value, pretty high-touch product. From there, they broadened out fairly quickly into a full suite of services. Personal loans, mortgages, banking, investing, and importantly, digital assets too.
So their long game strategy, it seems, has always been to become the ultimate one-stop digital bank. They want you to move your entire financial life from where you park your savings to where you get your home loan all inside the SoFi ecosystem.
It's an integration play.
Yeah, an integration strategy designed for sticky, high lifetime value customers.
And that strategic goal led them to, I think, the single most crucial structural detail we have to understand. So SoFi pursued and actually got a national bank charter back in 2022.
Okay, yeah, that's huge.
This is not like a trivial achievement. It's a serious competitive moat. When you possess that charter, it gives you full end-to-end control over your lending, your deposits, and how you structure your yield products.
Okay, let's slow down on that point for a sec, because this is where the how really matters for the listener. Why is having that bank charter such a colossal advantage, like in terms of cost structure?
It boils down to the cost of capital, really. Before the charter, if SoFi wanted to fund, say, a $100,000 personal loan, they had to go out to the wholesale market and borrow that money, maybe at 4.5% or 5%, depending on market rates at the time.
Right, which eats into their profit margin.
Heavily. Regardless of what interest rate they charge the borrower, that funding cost is there.
Okay.
Now, with the bank charter, they can accept customer deposits directly. They might offer, 0.5% or 1% interest on a savings account.
Yeah.
Suddenly, they're lending money they essentially own, sourced very cheaply through consumer deposits.
Which are also FDIC insured, right?
Which are also FDIC insured, adding that layer of trust.
Yeah.
So this difference lending money funded at maybe 1% versus money borrowed wholesale at 5%, it just massively lowers their overall operational risk and allows for much better loan margins.
That makes sense.
It's the core strength, really, that stabilizes their entire operation.
So effectively transforms them from maybe a high-cost lender that's reliant on external funding into a more self-sustaining financial institution.
Exactly. It's a very traditional banking approach, fundamentally, just delivered digitally.
Right. Now, contrast that stable sort of infrastructure-heavy approach with Robinhood.
Yeah, totally different vibe.
Yeah.
Their origin story is pure disruptive philosophy.
Velocity.
They didn't start with loans or deposits. They started with zero commission trading.
Yeah.
Their goal wasn't to be your bank. It was to revolutionize how you interacted with the stock market, period.
And they certainly did that. Completely upended the brokerage industry.
No question.
They democratized access to the markets for millions, especially, the younger demographic, attracting Gen Z retail traders who maybe had never even considered investing before.
And that rapid capture created massive user volume, huge numbers. But as you mentioned, it kind of pigeonholed them initially. Their early revenue relied almost entirely on trading activity and that controversial practice, payment for order flow, PFOF.
Which we'll definitely need to dig into later.
Oh, yeah. Highly volatile and constantly under regulatory scrutiny.
So their pivot strategy now is about diversifying away from relying just on that volatile trading revenue, isn't it?
Absolutely. We see them aggressively cross-selling now. Wider financial services like IRAs, high-yield cash accounts, credit cards, recurring investments.
Trying to monetize that huge user base.
Exactly.
Yeah.
Monetizing that massive, 24 million user base they captured initially. It's about getting more value from each user.
And critically, the source material really stresses this massive shift toward digital assets, crypto.
Yes. Crypto trading is now not just some add-on product for Robinhood. It appears to be a core strategic focus. It signals where they see the highest volume potential and, frankly, where retail interest is headed globally.
So very different foundations, setting up very different future paths.
Okay, let's pivot our focus now, maybe entirely, to the listener who's specifically interested in crypto. Because regardless of their structural differences, both SoFi and Robinhood act as absolutely critical bridges.
Bridges between what?
Between traditional finance, TradFi, and the decentralized crypto world.
Okay, yeah, the on-ramps.
They're the on-ramps to mass adoption. That's a great way to put it.
Right.
For crypto to really go mainstream, the user experience can't involve setting up complex nodes or navigating these obscure international exchanges. It's too much friction.
Right, it needs to be easy.
These fintechs provide that accessible, low-barrier access to digital assets. They make the process feel standardized, familiar, like buying a stock.
But, and this is key, their approach to crypto is fundamentally different, right? Reflecting their underlying DNA.
Totally. So FI's strategy is, I'd say, conservative and compliance-focused. They offer regulated crypto investing entirely within their application environment. It stays inside their walls.
The walled garden.
Precisely. SoFi's priority is compliance and just seamless integration into their existing bank structure. They seem to view crypto as just another financial asset class, like a stock or a bond, that should be securely housed in a comprehensive, highly regulated financial ecosystem.
So you buy it there, it stays there.
Pretty much. Your assets are secure, regulated, easy to access, but you can't necessarily take them out and use them in the broader DeFi world or for staking outside their platform, things like that.
Which is probably very comforting for someone who prioritizes security and regulation above all else.
Absolutely, but it might frustrate the crypto maximalist who wants true decentralization and control.
Yeah, the not your keys, not your crypto crowd.
Which brings us neatly to Robinhood. Their approach is significantly different here. Robinhood integrates crypto trading, but also offers self-custody wallets.
Okay, that's a big deal.
It's a huge strategic differentiator, and it fundamentally changes the user experience and, importantly, user responsibility.
Can you explain the difference in practical terms for the listener? What does self-custody mean compared to the SoFi approach?
Sure. In SoFi's walled garden, you're buying the asset, you own the economic value, but SoFi holds the keys, the private keys on your behalf. You own the asset on their books, but you cannot move it outside the SoFi ecosystem to, say, pay for something, interact with DeFi protocols, or stake it somewhere else.
Got it. Controlled environment.
Right. Robinhood's self-custody wallet, however, allows users to actually withdraw their crypto, Bitcoin, Ether, whatever, and manage their own keys if they choose to.
If they choose. So it's optional.
It's optional, but the capability is there. And this is a crucial pivot. It means Robinhood is positioning itself less as just a regulated broker offering a crypto feed.
Right.
And more as a direct and maybe necessary bridge to the decentralized web itself, Web3.
So, okay, on one hand, this positions Robinhood as maybe a direct mini-competitor to dedicated exchanges like Coinbase, kind of blending the speed of an exchange with a familiar fintech platform.
You can see it that way, yeah. Offering both brokerage and more direct crypto access.
But doesn't self-custody introduce pretty significant security risks to the average user? I mean, managing your own keys sounds complicated and risky.
It absolutely does. The maxim in crypto is not your keys, not your crypto. Self-custody gives you that true censorship-resistant ownership.
The holy grail for some.
Right. But it also means you are solely responsible for the security of those keys. If you lose them, if your device is compromised, Robinhood cannot help you recover your assets. They're gone.
Wow. High stakes.
Very high stakes. So what's fascinating here is just how differently they're approaching the regulatory side and the user responsibility side of digital assets.
Yes, stark contrast.
SoFi is basically taking on all the compliance and security burden to offer maximum ease of use within their system. Robinhood is leaning more into the decentralized ethos, which definitely appeals to a different, perhaps more sophisticated or risk-tolerant segment of the crypto market.
But places the security responsibility squarely on the user.
Yeah.
Exactly. A fundamental choice for the user and a fundamental difference in strategy.
Okay, this is where we stop talking philosophy and, start drilling into the hard numbers. We've got Q2 2025 source material here. We need that side-by-side comparison to really show their current state and, maybe more importantly, their momentum.
Right. The rubber meets the road with the financials.
Let's start with revenue and growth. The data here clearly shows Robinhood currently has the velocity advantage. They clocked in higher Q2 2025 revenue, around $612 million. But the real story, I think, is the speed. Robinhood showed significantly faster year-over-year growth, surging at 41%. That's huge.
Yeah, 41% velocity is impressive. And according to the sources, that was primarily driven by higher trading activity, specifically these massive spikes in crypto and options volume.
So market-driven.
Very market-driven. Robinhood is essentially an engine built for volume and, well, market euphoria. When things are hot, they thrive.
Okay, so SoFi, by comparison, they reported Q2 2025 revenue at a very respectable $555 million. Still strong.
But growing at a more measured 20% year over year. So this really illustrates that foundational business model difference we talked about, doesn't it?
It really does. Robinhood harvests that short-term, high-volume activity. SoFi is trying to build more predictable, steady, compounding revenue streams over time.
And the composition of that revenue is maybe even more telling, right? If we look at SoFi's $555 million, a large chunk is recurring income from loan payments, service fees.
Stuff you can count on.
Right. Plus their technology platform segment, Galileo. That's interesting.
Yeah, Galileo processes payments and banking services for other fintechs. They're essentially selling the digital infrastructure they've built for themselves. That's a highly stable B2B income stream. Less glamorous, maybe, but steady.
Very steady. Whereas a large percentage of Robinhood's $612 million is that high-velocity, transaction-based income, crypto trading fees, options trading fees.
Payment for order flow.
PFOF, yeah. And also interest income derived from holding massive customer cash balances.
Right. If the markets suddenly go quiet, SoFi's loan payments mostly still come in. Galileo keeps humming. But Robinhood's primary driver, that trading activity, it can slow to a crawl pretty fast.
Big difference in predictability. Now, we have to talk profitability. This is a major signal of maturity, right?
Huge signal.
SoFi recently achieved GAAP profitability. That's generally accepted accounting principles. This is a massive, non-negotiable milestone for any growing company, especially a bank.
It really is. It signals that they've proven they can run the entire complex regulated digital banking apparatus at a net positive. Even factoring in all the necessary compliance costs, the scaling costs, they're in the black on a GAAP basis.
That's big. Now, Robinhood also returned to profitability.
They did.
But we need to emphasize the distinction here, as highlighted by the sources. Robinhood's profitability was driven more by aggressive cost-cutting measures, streamlining operations.
Which is good management, to be fair.
True. But also significantly benefiting from higher interest income on the cash balances their 24 million users hold.
Right. They earned a substantial risk-free return simply by parking client funds in short-term government securities, essentially. A big benefit of the high interest rate environment we've been in.
So that makes Robinhood's profitability potentially more dependent on interest rates, maybe less a function of core operational efficiency than SoFi's GAAP achievement. Is that fair?
I think that's a fair assessment based on the analysis, yeah. SoFi's is more structural. Robinhood's has a significant macro tailwind component right now.
Okay. Moving to scale. Robinhood clearly dominates here. They boast a staggering user advantage, roughly 24 million accounts.
Just a massive number.
And the sources note increasing reactivation among retail traders, too. The users who maybe retreated during the 2022 bear market, they're being lured back by new products, renewed market excitement.
Now the buzz is returning a bit.
SoFi, meanwhile, is growing steadily, sitting at over 8 million members. Still impressive growth.
Definitely not small.
But the crucial differentiator here might be the depth of engagement, right? While Robinhood wins easily on breadth, 24 million users, SoFi seems to be aiming to win on depth.
How so?
Well, SoFi members often consolidate their primary banking relationships there, using the platform for checking, savings, loans. It creates a stickier, probably higher value relationship over time.
Right. The center of financial life goal.
Exactly. Whereas Robinhood users, maybe historically, often use the platform more for the specific purpose of trading or speculation, maybe not their main bank.
That's a key distinction in user behavior. And it brings us back neatly to their distinct financial advantages. For SoFi, we keep saying it, but it's the bank charter.
The charter, yeah.
That allows them to arbitrage the cost of capital. They can offer higher yield deposit products to attract cash while securing lower funding costs for their huge lending portfolio. It stabilizes income regardless of market volatility.
It's a structural advantage.
It really is. And for Robinhood, the advantage is that dominance in retail trading, coupled with providing that real-time crypto access. Their model is just designed to generate quick, high-volume revenue during market spikes.
Right. When the market moves fast, Robinhood is perfectly positioned to capture that transaction volume. It's an engine linked directly to the excitement cycle, the volatility cycle.
Speed versus stability again.
Okay, so we've established the structures, the financials, the core differences. Now we need to analyze their strategic roadmaps. What are the explicit long-term paths they're carving out to achieve multi-year growth?
Right. Where are they headed next? Let's start with SoFi's path. The source material kind of labels it the model for neobank stability.
Stability, okay.
They seem committed to doubling down on their core competency, lending expansion. This means continuing to grow their portfolio across personal loans, student loan refinancing, mortgages, making sure they have diversified credit exposure.
Not putting all their eggs in one basket.
Exactly. And critically, they're focused on building those long-term, predictable, recurring revenue streams.
From where?
Well, predictability comes from increasing deposit volume, getting more people to bank with them, cross-selling insurance products, driving daily usage of investment accounts, credit card accounts. It's about embedding themselves deeper.
Makes sense.
This intentional focus makes their cash flow more resilient against sudden external shocks, like a market downturn.
We also see a significant institutional play happening through their technology platform, right? Galileo.
Yeah, Galileo isn't just some back-end tool. It's a real revenue source. They're integrating and partnering with established firms, even firms like Coinbase apparently, to enhance their regulated crypto offerings.
So using partners to offer crypto compliantly.
Exactly. Ensuring they offer digital assets in the most compliant way possible, fitting it neatly within their bank framework. It's all very buttoned up.
So this really positions SoFi as a digital-first neobank that's built for sustainability. The sources suggest their structure actually allows them to thrive even in high interest rate environments.
Wow.
Because those higher rates actually improve their net interest margin in them. They're earning more on the money they lend out relative to the lower rates they pay depositors.
Ah, the classic banking spread.
Exactly. That's classic low volatility bank growth just delivered digitally.
Okay, very clear path there. Now let's pivot sharply to Robinhood's path, which the sources dub global crypto aggression.
Sounds punchier.
It definitely is. Their plans seem much riskier, frankly, and are centered almost entirely around capturing the next wave of global digital asset engagement.
How are they doing that?
They have aggressive targets, listing far more tokens, introducing staking capabilities so users can earn passive income on their crypto,
Big features.
and aiming for broad global trading availability, moving beyond just the U.S.
And the acquisition of Bitstamp fits right into this, doesn't it?
Perfectly. The 2024 acquisition of Bitstamp is the clearest evidence of this strategic pivot. Bitstamp isn't just some startup. It's a critical piece of infrastructure.
What does it give them?
It's an established global crypto exchange, particularly strong in the European Union. Acquiring it lets Robinhood rapidly bypass potentially years of regulatory hurdles and immediately expand their crypto operations internationally.
Wow, like a shortcut to global crypto markets?
Pretty much. It signals massive intent. They are seriously pivoting beyond the confines of the U.S. retail trading market. This is a global play now.
That's an aggressive move. Immediately increases their addressable market, accelerates their diversification away from just U.S. retail trading volume.
Which they need, given the PFOS risks we mentioned. They're also aggressively leveraging their existing 24 million U.S. users, trying to get more out of them.
Have.
adding new adjacent products.
Right.
Things like margin lending, IRAs that come with a 1% cash match that's a direct incentive to consolidate retirement accounts there, and new payment cards.
Using their huge user base as a captive audience for rapid cross-monetization, trying to become more of a financial hub.
Exactly. But, and this is a big but, the source material makes a key point about their inherent growth driver. It's highly dependent on a retail resurgence if crypto enters another bull market.
Back to the market cycles.
Yeah. While SoFi might actually benefit from high rates, Robinhood's engine revs fastest when excitement and speculation are high, generating that huge trading volume. They're betting big on the volatility cycle, a crypto cycle, to drive their most dramatic returns.
So a much higher beta bet, maybe?
Definitely seems that way. Higher potential reward, but also higher potential risk tied to market sentiment.
Okay, we've analyzed the upside, the strategies, the advantages. Now we have to transition to vulnerability. Where are these companies most exposed? And how will bigger macro factors influence their success or failure?
Right, the potential pitfalls.
Yeah.
Let's start with SoFi's vulnerabilities. Despite the stability that the bank charter provides, they still have heavy exposure to U.S. consumer lending. That's their core.
Meaning if the economy tanks.
Exactly. If the broader economic environment experiences a sharp downturn, if unemployment rises significantly, default rates on their personal loans, their mortgages, they will increase, maybe significantly.
That's credit risk. It's the inherent vulnerability of pretty much any bank, right?
No, it is. And furthermore, while the charter provides a huge advantage, it also subjects them to intense regulatory scrutiny. They're playing in the big leagues now, with big league oversight.
So more rules to follow.
Many more rules. Any potential tightening of regulation around consumer finance, or specifically around their still nascent crypto offerings, could significantly increase their compliance costs or maybe even restrict future product expansion. Regulators hold a lot of power.
And what about costs? You mentioned profitability is still thin.
Yeah, let's not forget scaling costs. Achieving GAAP profitability was a milestone, absolutely. But the profit margins are still relatively thin compared to established banks. They continue to pour capital into building and maintaining these complex banking operations, the fraud detection systems, the specialized customer service for loans, the regulatory reporting infrastructure.
It's expensive.
It's just expensive to run a highly regulated bank at scale, whether it's digital or bricks and mortar.
Okay, now for Robinhood. Their vulnerabilities seem, I don't know, more intense, very public certainly, primarily centered around regulation and the volatility baked into their business model.
Yeah, that sums it up. The first, and probably the most significant vulnerability, is that ongoing intense regulatory pressure from the SEC, particularly concerning payment for order flow, PFOF.
Right, we flagged this. Let's explain PFOF clearly again because it feels absolutely central to Robinhood's risk profile.
Okay. PFOF is basically how Robinhood makes money on its commission-free trades. When you place a trade on the Robinhood app, they don't typically send it directly to the NYSE or NASDAQ. Instead, they route that order to a wholesale market maker, a big firm like Citadel Securities or Virtue Financial.
Okay.
Those market makers then pay Robinhood a tiny fraction of a penny per share for the right to execute your order. They make money on the tiny difference between the buying and selling price, the spread. Robinhood earns literally billions from this practice.
Billions from getting paid to route orders.
Exactly. And the SEC's scrutiny focuses on whether this creates a conflict of interest. Are Robinhood users actually getting the absolute best possible execution price for their trades? Or is Robinhood potentially choosing the market maker who pays them the most for the order flow?
That's the core question.
That's the core question. If the SEC tightens regulations significantly, or, the nuclear option, outright bans or severely restricts PFOF, a major chunk of Robinhood's core revenue just vanishes overnight.
Wow, that feels like an existential threat.
It is. It's an existential regulatory threat they are constantly managing and lobbying against. Big time.
Okay, what else? Their high reliance on volatile trading volume is the second major vulnerability, right?
Absolutely. That 41% Q2 growth looks fantastic during a market upswing, but as the sources stress, revenue can just dry up in bear markets. We've seen it happen.
Yeah, 2022 was rough.
Right. When retail investors get scared and retreat, Robinhood's core transaction-based revenue engine slows dramatically. That forces them into aggressive cost-cutting measures, layoffs, like we saw in previous downturns. Their fate is tied to market enthusiasm.
Plus, competition now is relentless, isn't it?
Totally. Traditional brokerages like Charles Schwab, Fidelity, they now offer similar, sometimes even more expansive free trading services. Robinhood lost its initial unique selling proposition.
So they had to innovate.
which is why they're scrambling to innovate with new products, like that self-custody Robinhood wallet we discussed. It's a necessary move, partly to mitigate the risk of users leaving for true crypto exchanges, but it also adds technical complexity and new regulatory questions around crypto custody.
Okay, let's zoom out quickly to the macro factors shaping their competitive trajectory. Interest rates seem like a big one.
Huge. We've established that high rates generally benefit SoFi directly. Better loan margins, higher deposit arbitrage. It helps their core banking model.
Right. But conversely, those same high rates often hurt Robinhood, don't they?
Typically, yes. High interest rates make risk-free cash accounts, or even just high-yield savings, look much more attractive. That reduces the incentive for retail traders to gamble on higher-risk stocks or crypto speculation.
Takes the froth out of the market.
Exactly. That slows trading velocity, which directly hits Robinhood's PFOF and transaction revenue. So rates are a double-edged sword depending on which company you're looking at.
And the future of Robinhood's earnings feels inextricably linked to crypto price cycles. Way more than SoFi.
Oh, absolutely. Their revenue spikes dramatically during high-volume crypto bull markets. It makes them inherently more susceptible to those big cyclical market risks than the more stable, diversified SoFi model.
Okay, but despite their differences, both companies are united in needing one critical thing from the macro environment, aren't they?
Yes. Clear U.S. crypto regulation. Badly.
Clarity.
The way the U.S. ultimately classifies different tokens are the commodities like Bitcoin, securities like potentially many others, something else entirely, and how they regulate the centralized brokerages and exchanges handling them. That will fundamentally determine the long-term viability and the operating models for both SoFi and Robinhood in the crypto space.
So regulatory clarity or lack thereof is probably the biggest external factor determining the risk landscape for both of them going forward.
I would argue yes, it's hanging over everything.
Okay, we've really dug in here, analyzed the DNA, the deep data, the strategies, the risks. Now it's time to synthesize this, try to bring it to a conclusion based on the source material to provide some actionable insight for you listening.
Yeah, the bottom line, if we connect this all back to the bigger picture, the difference between these two companies really feels like a clear choice. A choice between high-velocity growth, maybe with more risk.
That's Robinhood.
And more institutional stability, maybe slower compounding growth.
That's SoFi. Velocity versus stability. Okay, so let's talk short-term first. Based on that Q2 2025 momentum we saw, the source analysis seems to point toward Robinhood being positioned for the faster short-term gains.
Correct. Robinhood is exhibiting that faster immediate revenue growth, 41% year over year. They clearly have strong crypto momentum right now. And that aggressive strategic move for global expansion via the Bitstamp acquisition, it positions them perfectly to capitalize on any global crypto resurgence.
So if the current, maybe more speculative market environment holds.
If it holds, Robinhood potentially offers more immediate, high-speed returns, more torque, if you will.
Okay. But the long-term winner, the company perhaps built more for endurance, resilience, compounding returns over many years, the analysis suggests that's SoFi.
Absolutely. SoFi's fundamentals just look significantly stronger on paper right now. They have those highly diversified, recurring income streams from lending and their tech platform. They operate a more sustainable, lower volatility business model, crucially underpinned by that national bank charter.
Right. The charter keeps coming up.
Because it matters structurally. That stability makes them a potentially more predictable long-term grower, far less susceptible to the wild cyclical swings of retail speculation and crypto prices.
Okay, so this means the right investment playbook here depends entirely on your conviction as the listener about the future economy and market direction.
Precisely. It frames the choice nicely.
So if you are making what we could call the crypto speculation play, if you believe primarily in rapid global crypto adoption, maybe another huge bull run, and the continuing resurgence of retail speculation driving massive transaction volume,
then Robinhood offers the highest potential upside. But it comes packaged with the highest inherent volatility and, crucially, that significant regulatory risk around PFOF and crypto classifications. It's the speed trade, the high beta play.
Got it. Conversely, if you are making more of the financial infrastructure play, if you believe in steady, sustainable digital banking growth, consistent margins, the power of regulated financial infrastructure slowly winning out,
then SoFi is the compounding, stability-focused option. It's the slower, steadier build toward potentially becoming the next great, diversified U.S. financial institution just built on digital rails. more of a long-term compounder.
Two very different bets on the future of finance. Hashtag tag outro.
Well, that really wraps up today's deep dive into this fintech face-offs, SoFi versus Robinhood.
Yeah, we've definitely seen the core tension play out. Velocity driven by trading revenue versus stability driven by regulated deposit and lending revenue.
Both are formidable companies, no doubt, but they're just built for entirely different economic conditions and different views of where the market is headed.
Very different animals.
And maybe one final provocative thought, just building on the source materials mentioned of emerging tech. Something for you to mull over.
Okay.
The growth race here might not ultimately be won by the company with the absolute best loan portfolio, or the one that lists the most crypto tokens. It might actually be won by the one that best utilizes AI-driven personalization and really sophisticated fraud detection.
Ah, the tech under the hood.
Exactly. The ability to scale securely, which is paramount in finance, and to truly personalize the user experience using AI. That could be critical for retaining users in what's becoming a hyper-competitive, heavily regulated financial landscape.
So that subtle innovation in retention, in making the platform indispensable and safe, that could ultimately be the deciding factor in this battle for your financial life.
It's definitely something to watch closely for both companies. Remember, this analysis, drawing from the sources, was designed to give you the comprehensive, hopefully unbiased insights you need to inform your own decision-making process.
We really appreciate you joining us for this in-depth analysis. Hope it was useful. We will be back soon with another deep dive.